Welcome back. Federal Bank posted an all-round great set of numbers. Return ratios are the best in what? 5-6 years. Loan growth the highest in or fastest in 3 years. Slippage ratio and cost to income lowest in about 3-4 years. But I can go on. It's really a record-setting quarter, and I have with me the author of this perfect set of numbers, Shyam Srinivasan, Managing Director, CEO, Federal Bank. Good morning, Shyam. Thank you very much for your time. Well, the first question is on return ratios. In our last chat, I think I was very unfairly asking you about return ratios, but you have actually walked the talk, performed so well in terms of returns. Just tell us whether this was a perfect set along with your effort, or this, the circumstances were special this time, or you think this record can be maintained, this pace of growth of both ROE and ROE?
Certainly, this is a new base, and thank you for that, Lata. We are, I think I've guided for many quarters. The effort has been to consistently keep improving and broad base everything, so we're never dependent on one thing working or not working. I'm happy that it's all coming together, and we had guided, if you remember, an exit rate of around 1.5, 1.2 this financial year, and a similar improvement the succeeding year. I'm happy we could upfront it and probably therefore improve it in the year ahead or years ahead. But it's driven by a bunch of stuff, a mix of business, the credit quality consistently improving. And we've been very, very disciplined in our deposit strategy, as you probably are aware. And so all the combination has come together. I'm hoping that this is the new base, and we'll keep working and improving on this. So it's not like it just didn't happen yesterday morning. It's been long years of effort, and I'm hoping it'll continue so.
Okay. Yes, I guess it's a mix of both that's leading domestic effort as well as the economy now having cleaned out balance sheets of corporates also being so much cleaner than before. Let me come to that. You gave a number of reasons why the returns have improved. So let me start first with advances. A very good number of 20%. Is that maintainable?
Yeah, we think high teens, closer to 20 is what we have been talking about. The last 2 quarters run rates have been indicative. This quarter in particular across the businesses, and I think I've mentioned on a few occasions that a lot of factors are advantage banks, and banks like us who have a good credit portfolio and are well funded, I think have a larger opportunity to accelerate into growth. There are new business that we started sort of just before COVID. We'd gone slow on that. We've now happily sort of stepping up on those. And those are businesses that we don't have much of a denominator. So I think every growth there counts. Cards, personal loans, commercial vehicles, microfinance are all beginning to sort of contribute. So I think our high teens growth is very possible, and we will be able to sort of deliver that and keep improving on that.
Okay. There was only one line in that advances growth that was kind of special. Corporate loan growth, that's grown year on year 20%, 20.7 to be precise, and quarter on quarter 7.2. Now, until recently, corporates were something people were afraid to touch. Every banker was flaunting how retail they have gotten. Now, you've gone ahead in the corporate line. Is it that the cycle is turning? Who is borrowing? And will that sustain? And, are there any dangers there?
I often say that we wouldn't want to venture where we're seeing too much danger. That's never been the philosophy of the bank. Corporate and consumer or retail, as you call it, we've almost been weighted 50-50 plus minus, right? Okay. It's never been heavily one or the other, and that's been for many years our plan. Okay. This quarter and this last 2 quarters, and in this quarter even specific, corporate saw good pickup, and I did mention the last time we spoke. It's a natural gravitation to banks by corporates, and those that have balance sheet and a relationship are able to get a larger share. Our credit book details are there in the public domain. We don't lend to segments or sectors that are riskier and or our ratings are not good. So it's heavily weighted towards the better segments. I'm happy to trade off pricing for quality and ensure that we have a full-fledged relationship. I think we should not see corporate growth just as the credit growth. If you look at the other income that we've grown from these corporates,
Yes, yes.
we're getting more entrenched in these clients. So we no longer are just a peripheral lender. We are a reasonably meaningful lender. We have a range of offerings on the corporate side too, which are beyond just working capital or term loan. We're able to do their FX, we're able to do their supplier, we're able to do their vendor financing, we're able to do buy account. And I think that's giving us traction. That's on the back of that is why we often guide for the kind of growth we are promising or we want to be putting together. And it's all, like I said, coming together. I never want to speak ahead of myself, but yeah, it's coming together.
No, I agree with you. Actually, what I should have said is that the fee income also has grown very well, not just the loan. The only reason, just Shyam, very quickly on in the sector itself, industry itself, now even global loans will become expensive. So you could see corporates coming to India. You could also see people migrating, like you said, from the bond market to the loan market. So, do we tend to get carried away by the loan growth figure? Is it for the banking sector as a whole? We've all been, beating our chest and saying, oh, loan growth is back. Maybe it is also because of these factors and not because of only economic growth?
Yeah, I think it's a combination. It's never one thing. It's not just economic growth by itself. I think it's the gravitation towards banks as the primary source of borrowing for corporates or clients. And banks are fulfilling that. And those banks that have balance sheet, those banks that have less of a credit problem, those banks that are not too distracted, have distribution, are, I think, gaining share, which is evident in our case. Our corporate and wholesale bank teams.
Sure.
And I say corporate, I also mean commercial banking, right? Because it's only a continuum, where you draw the line.
Okay.
Both are doing well. And it's heavily RM and relationship and product offering led.
Okay. Well, let me quickly get in. I'm being warned. So the more important question for you is, can you get these kinds of margins repeated? Do you have enough spare SLR or extra CRR? Or do you think this competition for deposits is going to plateau your margins?
The increase sequentially of 10 basis points is obviously the playthrough of the sort of repo transmission.
Yeah.
What we've been guiding, as you may recall, the full year NIMs were supposed to be something in the mid 325 or so. We're now reasonably confident that will trend up, maybe more to 330, which essentially means that the third and fourth quarter are here or even better.
Oh, okay.
Because 322 was the start for the financial year.
Okay.
So, if you have a 330 or 327, 328 as the full year, the remaining half will be a little better. And that'll be the base.
Okay.
Yeah, there is a sort of hot fight for deposits, but we are a little advantaged on deposits front, and not to say it's easy. Largely granular, largely retail.
Okay.
And the remittance business is doing remarkably well.
Okay.
And ultimately, it will translate to deposits. So I think the blend, our fintech relationships are good. We've opened 37 branches this FY. So those are all happiness.
Oh, yes. Actually, good. I'll end with the fintech question, though I'll take a rain check from you to invite you specifically for the banks and fintech relationship. The way RBI is moving, it doesn't look like it is giving the fintechs much space. If they open deposits, everybody should know it's a federal deposit and it is not a slice deposit. And the fintech can't even keep the data. So, how is this evolving? Will you all be going fintech all on yourself, or will you still rely on others? Are the fintechs even willing to give you that much help anymore?
Yeah, like you said, this deserves a full conversation.
Yeah.
But let me just point out, on all our conversations, I've always said we see fintech as a great collaboration. We've never seen that as a competition.
No, but are they willing, sir? Shyam, my point is they don't seem to be getting anything. Yeah.
Let me close out. Let me add. That's probably why we are a little more coveted bank partner for our fintech partners. We have played equal. We think that's a good formula. They have digital and distribution. We have platform. So if the economics work for both, I don't see any reason why either of us should chicken out. And we think we've got that formula going, and all our fintech partnerships are doing well. Yeah, there is always going to be some recalibration, but you never saw us back out because some of the new regulations didn't require us to stop anything.
Okay.
So our model has worked, and we believe that, and I do think it's a fairly sustainable model. Yeah, there are some outliers will always be there, which we'll have to clip out. But the core is working well.
Okay, good to hear that, and I will take that rain check, and we will speak about the evolving relation of fintechs and banks' own expenditure on technology at a later date. Thank you very much, Shyam. A very happy Diwali, and it looks like the next Samvat is going to be great for Federal Bank. Thank you for joining us.
Thank you so much.
We are winding up on Bazaar on the note that the markets have come back with a vengeance. HDFC Bank saw an initial profit taking, but it is leading the way up with Kotak Mahindra Bank as a close second. A good day for the bulls. You will have to say at least a good morning. We'll wrap up on Bazaar. Chartbusters up next.